Hello, today I am going to start to talk about risk management in banking industry. To start with, let me just talk about what we mean by the concept of risk. Risk is basically variability from the expected outcome. So if we are expecting an outcome X and the final outcome varies from X too much, that means the risk is very, very high. Now there are certain risks which banks would love to take. For example, risk of credit. Bank is basically a lender. So by lending to various sectors, banks are exposed to various risks, and primarily the risk is credit or default is very, very high. Now banks take this risk deliberately because that risk can give the gains or benefits to the bank. But if that risk is not managed well, it can also lead to a huge loss for the bank. Now the second type of risk what normally a bank faces is risk of market potentials or market deviations. So if market is unfavorable, the risk of the bank can be very, very high. So when we talk about market risk, it actually means what investments banks has made in various investment products of the market. So if a bank has made investments and if those investments are not performing well, the banks can have a huge losses which can sometimes lead to a default for the bank also. The third type of risk what a bank faces is called operational risk, which is neither market nor credit, but basically concerned about risk like cyber security or risk like robbery or fire or theft, which normally banks would not like to take. Market risk and credit risk are the risks which banks takes because it has got an upside, but operational risk is one risk which banks they would like to avoid because it has got only downside. Now there are many examples in the world in India wherein the banks have collapsed or banks have been in trouble primarily because of not managing the risk well, cases like Lehman Brothers or India cases like Punjab National Banks. So we'll talk more about this in the next video. Thank you very much.